The warning signs are flashing across the global economy, and most people still do not see them. A financial storm is building inside the United States, and now it is spilling far beyond its borders. Markets, governments, and major investors are quietly preparing for something big. And right in the middle of all this, a dramatic move just shocked the world. Donald Trump has demanded a $1 trillion lifeline from Saudi Arabia, a number so large, so bold, that it has pushed the entire conversation about the US bubble into a new and dangerous direction. This is not just another headline. It is a signal that the problems inside the American economy are no longer America's alone. When a bubble grows too large, the pressure spreads. Prices rise far above reality. Debt expands faster than growth. Hidden weaknesses rise to the surface. And when the United States shakes, the rest of the world feels it. From oil markets to global banks, from foreign reserves to trade flows, every part of the global system is now tied to the stability of the US economy in one way or another. That is why Trump's request matters. It is not just about money, it is about what it reveals. In this video, you will learn why analysts are warning that the US bubble is reaching a critical stage, why global markets are becoming more vulnerable each month, and how a $1 trillion demand to Saudi Arabia connects to all of it. You will see how political decisions are now mixing directly with economic risks, creating a chain reaction that could reshape global finance. You will learn the lesser-known details that major headlines leave out, how foreign investment is propping up US markets, why Saudi Arabia has become a key player, how global funds react when American leaders send signals like this, and why these events could easily turn a national problem into an international crisis. Stay with this video until the end, because the final section will break down the one factor most people do not talk about. The factor that could decide whether the bubble quietly deflates or violently bursts. Missing that piece means missing the real story. If you care about your financial future, your business, or even the stability of your country's economy, you will want to understand what is happening behind the scenes right now. There are connections here that mainstream news rarely explains, and once you see how they fit together, the entire situation becomes far clearer. Welcome to our channel. We break down the global shifts shaping the world one story at a time. If you want more deep analysis like this, make sure to subscribe and join us as we uncover the forces that are changing the global economy. A financial bubble is when prices rise far beyond what something is truly worth. It happens when excitement, speculation, and easy money push values higher and higher. Even though the real strength behind them does not match the price, people keep buying because they think prices will keep climbing, not because the asset has earned that value. This creates a fragile structure that only stands as long as confidence remains. Once doubt enters the picture, the entire inflated system can collapse quickly. Right now, many analysts believe parts of the United States economy show classic signs of this. Valuations in several sectors are stretched to levels that do not match profits, productivity, or long-term fundamentals. Stocks, especially in technology, are trading at levels that depend more on future hopes than current performance. The excitement around artificial intelligence has pushed investors into a frenzy, creating a situation where billions are being poured into ideas that may take years to prove themselves. This does not mean the companies have no value. It means the prices placed on them may be far ahead of reality. Along with this, there is a huge amount of liquidity circulating in the system. Years of low interest rates, large government spending, and aggressive investment behavior have filled the market with money that keeps chasing higher returns. When so much cash lies in the system, it naturally fuels risk-taking. Investors buy more, borrow more, and push prices upward, even when the underlying numbers do not justify it. This kind of environment is exactly where bubbles thrive. Another warning sign is how quickly markets react to small pieces of news. When a system is healthy, it can absorb shock. When a bubble forms, even a small negative event can trigger fear. Traders rush to protect profits, investors pull back, and volatility increases. You can see this pattern in recent market swings, where a single announcement can wipe out billions within minutes. That level of sensitivity is not typical of a stable system. There is also the growing dependence on a few dominant sectors. A large share of market gains comes from a handful of mega-cap tech companies. When that much weight sits on such few shoulders, the entire market becomes vulnerable. If even one of those giants faces a setback, the shock can spread through indexes, funds, and global portfolios. And this is where the stakes rise. When a bubble forms in the United States, it does not stay confined to one country. The US still sits at the center of global finance. International investors hold American stocks, American bonds, and dollar-denominated assets. Foreign governments rely on the stability of US markets. Global supply chains depend on American demand. So when valuations stretch too far and finally snap, the impact moves across borders, affecting currencies, trade, and the financial systems of countries far from the original source. This is why understanding these early signals matters. A bubble in the US is not just a domestic issue. It becomes a global event, shaping decisions, shifting capital, and creating risks that ripple across the world long before anyone realizes how connected everything truly is. The United States sits at the center of the global financial system, which means its markets are deeply connected to money flows around the world. When investors move capital into US stocks, bonds, or real estate, that decision affects financial positions in Europe, Asia, the Middle East, and beyond. Banks, hedge funds, sovereign wealth funds, and pension systems are all tied together through billions of dollars in cross-border investments. This network creates a system where the health of US markets influences the stability of many other countries, even those with very different economic conditions. Global capital flows follow signals from the United States. When US interest rates rise, money often leaves developing nations and rushes back toward the dollar. When US markets perform well, investors take on more risk and push money into foreign assets. When volatility rises in America, global investors usually pull back everywhere else. This cycle is constant, and it means the actions of the US Federal Reserve, Wall Street institutions, and large American corporations ripple across the entire world. A change in sentiment in New York can trigger reactions in London, Tokyo, Dubai, and Singapore within minutes. This interconnected structure also includes banks that lend to each other across borders. Many international banks hold US securities as part of their reserves. When those securities fall in value, the balance sheets of foreign banks weaken instantly. That is why global institutions watch US markets so closely. They know a sudden drop does not stay contained. Even a modest correction can squeeze liquidity, reduce lending, and create stress in financial systems thousands of miles away. This concern has grown because of recent warnings from major economic institutions. Analysts have pointed out that US markets are becoming more sensitive to shocks and could face a sharp correction if confidence shifts. When organizations like the International Monetary Fund issue such alerts, it usually means they see risks building beneath the surface. Their concern is not only about the United States, but about how the potential downturn could transmit through the global system. The impact becomes clearer when looking at what happens if US asset prices fall. Large international investors, from pension funds to national wealth funds, hold vast amounts of American stocks. A decline in those prices means instant losses. When these funds lose money, they reduce investment elsewhere. That directly affects emerging markets, which depend heavily on foreign capital to grow. A pullback in US markets can cause currencies in developing countries to weaken, borrowing costs to rise, and investment projects to freeze. Trade also suffers. When American households feel poorer because markets fall, they spend less on imports. Countries that rely on exporting goods to the United States feel that drop quickly. Even commodity prices can decline because global demand slows. From oil-producing nations to manufacturing hubs, the shock of a US downturn touches almost every corner of the global economy. This is why any instability in the United States spreads so quickly. The financial system is built on links that run through markets, banks, currencies, and investor psychology. When the core of the system shakes, the outer layers feel it almost immediately. The story took a dramatic turn when Donald Trump publicly pushed for Saudi Arabia to increase its investment in the United States by as much as $1 trillion. This was not a quiet discussion behind closed doors. It was a clear and forceful message aimed at one of the world's richest energy powers, and it immediately sparked debate across financial and political circles. A request of this size is rare, and it signals how important foreign capital has become for supporting the U.S. economy during a period of stretched valuations and rising uncertainty. Saudi Arabia sits at the center of global energy markets and controls one of the largest pools of investment capital on the planet. Its sovereign wealth fund, fueled by decades of oil revenue, has the power to reshape markets with a single decision. This is why American leaders often focus on Saudi Arabia when they want to strengthen economic ties or stabilize financial conditions. The relationship is not only about money, it is about strategy, oil supply, regional influence, and the broader balance of power. When the United States needs large-scale inflows of capital, Saudi Arabia is one of the few nations that can respond at such a massive scale. The dynamics behind this request are complex. For Washington, drawing in more Saudi investment helps keep markets stable, supports major projects, and adds confidence at a time when investors are becoming more cautious. For Riyadh, expanding investment in the U.S. secures political goodwill, strengthens security ties, and creates long-term financial returns in sectors like technology, infrastructure, and energy transition. Both sides benefit in different ways, and both understand that this partnership carries weight far beyond economics. However, the timing of this push raises important questions. When valuations are already high and liquidity is abundant, bringing in another $1 trillion of foreign investment can create even more upward pressure on prices. This can temporarily lift markets and make the system look stronger than it is, but such capital injections also risk hiding deeper imbalances. If the foundations of the market are unstable, external money can delay the correction, not fix it. It can make the bubble look healthier while the underlying weaknesses continue to grow. This is the concern many analysts point to. When a system depends on large foreign inflows to stay afloat, it creates a form of artificial stability. If that money ever slows or reverses, the same markets that looked strong can suddenly weaken. Heavy reliance on sovereign wealth funds, especially during times of inflated asset prices, can signal that the domestic market cannot sustain itself without outside support. There is also the geopolitical layer. A $1 trillion investment request ties financial stability to diplomatic relationships. It means market confidence becomes linked to foreign policy decisions, regional tensions, and shifts in alliances. If political interests clash or strategic priorities change, the flow of capital could shift quickly. This is why such events send waves through global markets. They reveal how financial strength, political influence, and global risk are all deeply connected, often in ways the public does not see. The current environment in the United States is shaped by an unusually large amount of liquidity. Years of aggressive monetary measures, fiscal expansion, and rapid credit growth have created a system where money moves quickly and in massive volumes. This abundance of liquidity fuels strong demand for both stocks and alternative assets, pushing valuations higher and making markets appear far more resilient than they might actually be. High valuations across sectors, especially in technology and real estate, reflect this surge of capital more than they reflect underlying economic performance. At the same time, the lines between what is considered safe and what is considered risky have started to blur. Assets that were once viewed as stable stores of value now carry more volatility. Government bonds move far more sharply than they used to, and the safe haven status of certain sectors no longer feels guaranteed. On the other hand, speculative assets gain mainstream acceptance, creating a landscape where investors chase returns in areas they previously avoided. This shift in perception is a key feature of a market driven by excess liquidity, where the search for higher yields pushes investors into unfamiliar territory. Another factor shaping this environment is how political and strategic decisions influence market behavior. When a major leader announces a large investment deal, a policy change, or a sudden shift in international relationships, capital flows adjust almost instantly. Investors watch these developments closely because they signal where future money may move. A statement from Washington or Riyadh can send global funds rushing into or out of sectors within hours. This reaction is not only based on economic logic, but also on the anticipation of how political alliances, trade agreements, or diplomatic tensions might shape future financial conditions. Such moves can make markets look stable in the short term because they boost confidence and attract new waves of capital, but they also introduce another layer of uncertainty. When economic strength depends heavily on political coordination, it becomes more vulnerable to sudden changes in leadership, international disputes, and shifting national priorities. A single announcement can create optimism, but another announcement can reverse it just as quickly. This environment makes it harder for investors to judge true value. When the boundaries between safe and risky assets fade, decision-making becomes more emotionally driven. Investors follow trends, chase momentum, or react to headlines rather than long-term fundamentals. As a result, markets become more sensitive, more reactive, and more dependent on constant inflows to maintain their elevated levels. The mix of abundant liquidity, stretched valuations, and fast-moving political signals creates a system that feels strong on the surface, but requires constant support to stay that way. When a major financial bubble in the United States starts to unwind, the first shock usually appears in the stock market. Prices that were pushed far above reality can fall very quickly once confidence slips. A sharp drop erases trillions of dollars in paper wealth, and that loss affects households, companies, pension funds, and global investors at the same time. A market crash also changes behavior. When people feel poorer, they spend less. When companies lose value, they cut costs and pull back on expansion. This sets off the next stage of pressure. As markets fall, credit conditions begin to tighten. Banks become more cautious, lenders demand higher interest rates, and borrowing slows. This affects everything from home purchases to business loans to government financing. When credit dries up, economic activity slows even faster. Firms delay investments, households reduce spending, and financial stress moves from the markets into the real economy. This tightening can then spread through global banks, many of which hold U.S. assets or are linked to American borrowers. When a U.S. bank feels strain, the institutions connected to it through cross-border lending feel the strain too. These pressures combined can push not only the U.S., but the wider world toward recession. The American economy is one of the largest buyers of foreign goods, services, and commodities. When demand weakens in the United States, global exporters feel the loss immediately. A drop in American consumer spending can hurt manufacturers in Asia, resource producers in the Middle East, and agricultural exporters in Latin America. Each of these industries depends heavily on U.S. buyers, and a slowdown at the center can reduce production, lower profits, and cause layoffs in distant countries. Currencies also react quickly. When U.S. markets fall and credit tightens, investors rush towards safety. That often strengthens the dollar and weakens the currencies of developing nations. A weaker currency makes imports more expensive, raises inflation, and increases the cost of paying back foreign debt. Countries that rely on external financing can face serious pressure as their borrowing becomes more expensive and their reserves shrink. One simple scenario shows how deeply connected the world is. If U.S. households cut back on buying electronics, factories in Asia reduce orders for parts, shipping companies handle fewer containers, and raw material suppliers earn less revenue. Another scenario shows the financial side. If American banks face stress and tighten lending, global banks that depend on U.S. dollar funding may struggle to maintain liquidity, forcing them to limit loans in their own countries. The link between the U.S. and the rest of the world runs through trade, investment, banking, and psychology. Even nations that believe they are insulated eventually feel the effects. When the world's largest financial system slows sharply, the ripple spreads through every sector, from manufacturing to energy to finance, creating challenges that cross borders faster than many expect. Across the United States, valuation metrics in both equities and real estate continue to stretch far above long-term averages. Price-to-earnings ratios in several major sectors remain elevated, pushed higher by years of strong liquidity and aggressive investor optimism. Homes in many cities are selling at prices that do not match local income growth, creating gaps that only survive when credit is cheap and demand stays intense. These inflated valuations suggest that even a modest shift in interest rates, earnings expectations, or market sentiment could trigger a sharp correction. When prices lean too far away from fundamentals, stability depends on everything going right, and that is rarely how markets behave for long. At the same time, the landscape can shift quickly whenever a major geopolitical or investment announcement is made. A single statement from a global leader, a massive investment promise, or a sudden shift in diplomatic relations can temporarily lift markets. The recent call for a huge Saudi investment is just one example of how external forces can inject new confidence, even if the underlying conditions have not changed. These headlines create short bursts of optimism, pushing up stocks or improving sentiment, but they often act as temporary patches on deeper issues. Investors know the excitement does not fix structural problems. It simply delays the moment when those problems demand attention. Meanwhile, global capital flows remain highly sensitive. When the US looks strong, money pours in from all over the world. But when signs of stress appear, the flow can reverse quickly. Investors pull out of riskier markets, shift into cash, and move back toward perceived safe assets. This rapid movement of capital can create major disruptions in emerging markets, raising borrowing costs and causing local stock markets to fall. Even developed economies feel the shift when large funds rebalance their portfolios. A reversal of capital flows is often the first warning that confidence is weakening, and once that process begins, it can accelerate faster than expected. Another growing concern is the expansion of shadow banking and other non-bank financial institutions. These firms operate outside the traditional regulated banking system, but still handle huge amounts of money. They provide loans, manage investment products, and take on risks that used to be confined to banks. The problem is that many of these institutions are less transparent, less regulated, and more exposed to market swings. When trouble appears, they can amplify the shock because they are tied to complex financial instruments that react sharply to changes in interest rates or asset prices. As this sector grows, it quietly increases the vulnerability of the entire financial system. These factors together create a market environment that appears strong on the surface, but depends heavily on confidence, liquidity, and constant inflows. When valuations stretch, when geopolitical events drive temporary optimism, when capital flows become unstable, and when shadow institutions operate without oversight, the system becomes more fragile, even if it looks healthy. Each part adds another layer of risk waiting beneath the surface. In a period when markets rise quickly and optimism spreads easily, it becomes even more important to stay diversified. Relying too heavily on a single sector, a single asset class, or a single country exposes investors to sudden shocks that can erase gains far faster than they were earned. Diversification does not eliminate risk, but it helps soften the impact when conditions change. When the financial environment becomes unpredictable, spreading exposure across different areas becomes a practical form of protection rather than a cautious habit. It is also essential to look beyond the headlines that dominate daily news cycles. Headlines often focus on dramatic events, short-term reactions, and political statements. They can distract from the deeper structural issues forming beneath the surface. Watching for long-term trends, like corporate debt levels, credit conditions, labor productivity, and capital flows, offers a clearer picture of where the economy is truly heading. Structural signals, not momentary excitement, reveal the health of the financial system. When these underlying indicators begin to shift, markets often follow, even if the news still sounds positive. Recognizing global risk is just as important. Many people assume that a crisis in the United States will not affect them if they live in another region, but the interconnected nature of modern finance means a major event in the US influences currencies, trade, investment flows, and commodity prices worldwide. A decline in American demand affects exporters across continents. A tightening of US credit conditions influences borrowing costs everywhere. Even countries that feel distant from Wall Street are tied to its movements, through the systems that support international trade and finance. Understanding this helps individuals and businesses prepare more effectively. Another mindset to avoid is the belief that some institutions, companies, or countries are too big to fail. History has shown that size does not guarantee stability. Large banks have collapsed, major corporations have disappeared, and powerful governments have faced severe financial stress. When markets rely on the assumption that certain players will always remain strong, the risk becomes greater, not smaller. That kind of confidence can lead to complacency, excessive risk-taking, and shock when the unexpected occurs. Staying clear-eyed about the possibility of failure, even for big institutions, encourages more cautious decision-making. In times when markets appear strong and the global system looks stable, these principles matter even more. Diversification, long-term observation, awareness of global connections, and avoidance of false confidence help create a mindset that can navigate uncertainty. They offer a grounded approach in a world where financial conditions can shift with little warning and where the impacts ripple far beyond their origin. The US bubble risk, the sudden push for a massive Saudi investment, all of it points to one thing. We're entering a high-stakes moment. What happens in America won't stay in America. The ripple effects are already moving through global markets, energy alliances, and investment flows. And that sets the core message of this video. This isn't just a US problem, it's a global shockwave in the making. So stay alert, stay informed, because the next few months may decide far more than most people realize. If you found this breakdown useful, hit like, subscribe, and tap the notification bell so you never miss these deep dives into the world economy.